All right, first, let's start off with that hotter than expected inflation print, that PPI figure. For that, we want to bring in Thomas Simons. He's Jefferies' a senior U.S. economist. Thomas, it's great to have you here. So first, just give us your reaction to that PPI print out this morning and whether or not that really is helping or maybe fueling some of the concern out there surrounding inflation. Maybe the worst isn't over.
Yeah, good morning. I think that it's an interesting dynamic that we have here this month because we have the PPI data released the day before the CPI, right? The CPI, I think, is actually much more sort of informative about what's going on with consumer inflation and what people are really seeing on the shelves and prices at the pump, et cetera. What they're actually paying out of pocket. But the PPI data is informative about things like margin that producers are capturing, and sort of like how much they're able to pass prices through to people that are influencers that are further on down the supply chain, right? So we see some pretty strong pricing power here for the data that we got in April. You mentioned earlier there were some downward revisions to the March data. But as we see things here this month, it suggests that there is still some pretty significant inflation pressure that is going to continue to be passed along.
Thomas, if we continue to see a higher than expected print come in for CPI, what does that do for the Fed's calculus? And does that mean that we won't get a cut until perhaps December or even next year?
Yeah, I mean, that would be consistent with our view. We don't think that we're going to see any rate cuts before maybe November or December. And at this pace, possibly not even this year at all. The inflation data continues to show that there is risk that if the Fed were to cut rates, that they, could risk, stoking the inflation pressures even a little bit more and potentially sending inflation to higher levels that are, really uncomfortable relative to to their 2% goal. So, we still see the economy as generally being relatively high pressure. There are a lot of different sources of inflation that are not really particularly sensitive to interest rates, but those that are going to, sort of obviously, jump higher again if interest rates are cut. And broadly, we see a lot of issues with just an inability for the economy to really expand capacity to produce, more supply in areas, especially in the service sector, where there is significant demand, and in a lot of cases demand that is inelastic and difficult to really see substitutes for.
Thomas, talk to us a little bit more about the relationship between CPI and PPI and how much PPI is really an early indicator or a leading indicator of maybe what we could see tomorrow morning.
Yeah, so I mean, getting a little bit inside baseball, I suppose, the PPI and the CPI are, I guess, a little bit sort of less related than they used to be in the past because of some methodology changes that went through with the PPI a few years ago. But right now, when we look at the PPI, again, I sort of hinted at this a little bit earlier, it's really measuring the margin that's captured by wholesalers. So to the extent that they are capturing more margin and PPI goes up, that means that their pricing power is improving, that they're more and more able to pass through price increases to the agents sort of further on the supply chain, and the consumer really is that last person on the supply chain, and eventually is one that's going to be seeing that price increase eventually is sort of at the end, and I think that if we were seeing a stronger disinflationary trend, we would see it in the PPI first, right? We would see first that producers are less sort of, able to pass through price increases. Their margins would shrink. That would eventually lead to, consumer prices falling further on down the chain. But to the extent that we see the, continued price pressure here earlier on in the supply chain, it suggests that we're further away from seeing more relief for the consumer.
Thomas, I know you're an economist. You're probably not tracking some of these earnings reports that come out at the same degree that we're discussing them on a daily basis. But for a lot of the CEOs that we've heard from over the course of the earnings season, they're trying to really spell out what this macro environment means for their business and where consumers are starting to push back on price. If there is, from the economist perspective, areas where you're starting to see that more pronounced than others, where is that as we continue to try and figure out which CEOs are being extremely forthright versus those who are perhaps just trying to go under the veil of what everyone else is citing?
Yeah, I mean, I would agree that as an economist, I'm probably one of the worst persons to be, sort of thinking about single names and stocks and kind of analyzing the individual businesses. But I do try to pay attention to earnings reports to get a sense of kind of the temperature of the room, especially as it relates to the consumer. And right now, I think what we're seeing is just a really, 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 really mixed picture, right? Whether it's better health of consumers that are at the upper end of the income stream than at the lower end, or just differing, consumer tastes. Clearly, we went through this period of time post-pandemic when seemingly demand was strong for everything, and now consumers are becoming a little bit more discreet and more discerning about what they're spending their money on. I think that we're going to continue to see that. We're going to see more trade down activity and more kind of indications that sort of middle of the range consumers are probably squeezed a little bit and having to make some more difficult choices in terms of what they're spending their money on. The higher end, I think, is going to continue to do quite well, and the lower end is going to do okay so long as we continue to see more wage gains down at the sort of lower end of the income spectrum. But really that middle ground is where the sort of overall delta for the economy, for the stock market really lies, and that is a very muddled, mixed, messy picture right now. It's very, very hard to have a strong view on exactly how those folks are really sort of getting by.
All right, Thomas Simons, always great to talk to you. Thanks so much for hopping on with us this morning. Jefferies, a senior U.S. economist.
Thank you.